connect with him. It's been a while we've interacted with him. Gautam, good morning. Nice to have you back. Back to India, if I may say so.
Morning, Nikunj.
How are things?
Yep. Hi, Nikunj. All good, all good. Good to see you after a long time.
Yep, it's been a while actually. I just want to start with one simple thing that doesn't matter whatever we are discussing. What matters is that what FIs would do. The intensity of selling is so brute that one is trying to figure out that for India, which was the best story in the town, suddenly is now on the receiving end of the flows. What has changed? Why are we getting this daily outflow from foreign institutional investors of nearly $500 million?
Hey, look, first, let me comment that the scale of selling, while dollar billions might seem large, in the context of their aggregate holdings in India, is still not that meaningful yet. So if you compare dollar billion numbers now versus history, it's obviously very, very high. But their holdings in India are also much, much larger now. That's the first point. Then why they're selling last few, I would say, months, is effectively a mix of valuations, positioning, and the growth deterioration we have seen in India, and also the opportunities they see in some other markets. And finally, overlay with all of this with the fact that it's not just India. It's a point is selling has been happening in a broader emerging market sense. It's FIIs in general buying more US or Americas versus the rest of the world.
Okay. And do you think this trend could extend itself for next couple of months?
So look, there are 2-3 things here. In the short term, it could. Difficult to be sure or predict. Our discussion with FIIs does suggest that they still are looking for bottom-up opportunities, looking for trades around the budget. So it's not that a one-way street of them wanting to sell in a way. Even today, in the last few days, when we've seen big numbers on a daily basis, there has been big gross buying number also. So the net number is negative, but there has been a reasonable gross buying number also. It's not just gross selling. When does it change? I think boils down in a big picture way. From an India perspective, there are obviously global factors at play, including what Trump does, what China does, etc. But from an India perspective, it's policy, it's reforms, and by policy it means both RBI and central government.
But you think really budget could be that one trigger or pivot point wherein the FII sentiment could change? I mean, what's anticipated from the budget this time?
So look, the way I'll put the FII sentiment around the budget is they all acknowledge that with the fiscal consolidation roadmap, the room to really stimulate in a meaningful way is limited. However, what they would be looking for is signals towards course correction in terms of the spending mix. Any signals we see around that is what the markets would be looking at. Secondly, look, historically, we have seen the budget becoming more and more about fiscal policy rather than a big platform to announce reforms. Again, do we see a change in that? That can matter for sentiment as far as the budget day is concerned. But for investors, they would look at direction towards fiscal consolidation roadmap and spending mix. There have been concerns of the last few months, given the post-elections rise in spending towards consumption and populism in state governments. Is it something which will continue for a period of time, or is it short-lived and therefore we'll see a course correction? Those are the things markets would be looking at, FIIs would be looking at closely. Ultimately, they're looking for a recovery in growth rates in India.
Other than that, Gautam, I mean, of course, this week you've got the Fed meet, and then next week we've got the RBI policy as well. What kind of RBI action would give markets comfort, you think?
So look, our house view is a 75 basis point shallow easing cycle. I don't think that's different from the street. What the street would be looking at is more around the liquidity easing part. We have seen first steps towards that is when we saw the CRR action last month. But will we see more support for the liquidity environment and therefore credit growth to pick up as demand comes back? That's something which markets will watch very, very closely.
Gautam, when you say the gross number is not looking bad, so we are seeing a churn in FIs, and the clients whom you interact with, which way are they leaning? I mean, the traditional FI favorite stocks have been IT, financials, consumer. Is that preference changing?
So if you look at the last 5-7 years, we have seen the FIIs who've been around in India for many, many years. A lot of their well-owned stocks didn't necessarily do well. The large private banks or IT or even consumer staples, etc. And so beyond India, positioning for them in the EM context, the stock picks also didn't help. We have seen investors trying to work around that, but we haven't seen investors, for example, jumping in a big way into industrials yet. Selectively, yes, but not in a broad-based way. We still haven't seen investors jump back in a big way into, say, SOE banks. So those stocks and sectors which did very well last year, we haven't seen the FIIs chase them. And despite the correction we have seen the last couple of months. So FIIs are still sticking to the old ones, I would say, in a very broad way, but also looking for stock-specific opportunities beyond the traditional favorites.
But Gautam, what's the big concern when it comes to India? Was it bloated valuations? Or is it more, growth concerns now, which were pretty concentrated for the rural end of the economy and now seem to be trickling upwards as well?
So I would say the valuations has been rich in India for the last 20-25 years, at least in a relative context. It's always traded at a premium. And what justified that was a mix of both near-term outlook as well as long-term, or what's terminal growth rate for businesses. And I think when we see near-term growth surprising negatively, as we have seen the last couple of quarters, and that's when it's very typical of markets to start debating whether it means something more for longer-term growth rates. Now, based on investor discussions, based on what various economists have written, I haven't seen any debate or doubts yet about the long-term growth potential. The potential growth rate forecast for GDP even now hasn't come down, either by the policymakers, by our economists, etc. But investors were negatively surprised by the last two quarters' growth rates. And again, very simplistic, if we go back to August, September, everyone was talking about a weak 2Q, but the actual earnings were far worse. The actual GDP print surprised negatively. And that's what's hurt markets rather than just valuations. Valuations being rich, positioning being heavy didn't help, obviously, which are getting normalized in the last couple of months of correction. So that is helpful. As we see as we see a recovery in growth rates, I think markets are or could get support from the current level of valuations.
Interesting. Gautam, I know it's too early and it's kind of that black box, but how do you think the Trump regime is going to play out, and what would it mean for emerging markets, much like India?
So look, India is relatively less affected given its position in global trade that we all know. What the direct impact or even indirect impact on India will be far more through how any Trump policies affects US growth, because there are companies and businesses in India which are very well exposed to US growth. IT is a classic example, or how it affects global growth. So any Trump policies, if it affects global economic growth to slow down, or it impacts US economy to do well, that's the direct and indirect impact on India. So we'd be less worried about, okay, there are some tariffs and how it impacts India's trade. That will be less of an impact. The other debate around what Trump does, etc., is around the China plus one thesis. Now, the first point here is the China plus one thesis is not a 1 year, 2 year, 3 year. It's a decadal kind of thesis or theme. These things don't play out overnight. Again, will Trump policies affect that hope or hypothesis around that? We have to see that. That's clearly a black box, because there have to be multiple level of policy actions from Trump, and then we analyze them holistically. So that's difficult to predict right now. But otherwise, the building blocks for India to do better and grow on its manufacturing space in general, that still remains in place.
Okay. So what is reaching what could be called as a fair value or a real value, where you would say that use the current volatility in the market to just grab?
So there are pockets. Again, the first thing I'll say, Nikush, there is at a big picture level, current markets, next 3-6 months, or even 1 year, this is less about trying to participate in styles or themes or even sectoral allocations. The next 3 months or 12 months is going to be much more about stock selection, even within large sectors. And that's what our analyst views typically are reflecting across sectors. We are seeing analysts making stronger pitches on both buys and sells rather than a big sectoral call, whether it's IT, whether it's autos, whether it's financials. So across sectors, there are opportunities. Like financials, for example, the large, high-quality private banks, we clearly see an opportunity there. Risk-reward is very, very attractive, both in terms of where they are on the credit side, where they are on the growth side, and how they can participate in any growth recovery. Same for IT services. We see opportunities in some of the larger names where they can benefit from how the US economy pans out post-Trump. So there are opportunities at an individual stock level, which we see compelling enough for investors to look at.
In general, I mean, are mid and small cap stocks at Humpty Dumpty levels, or they've corrected fair degree now?
They're corrected, but again, at a big picture level, their relative value to overall large caps still doesn't give us attractive risk reward. Therefore, they're still quite a distance away before they become attractive at a regional relative level. But having said that, small mid caps also typically have higher growth, higher earnings growth. That still remains intact at a broader level. And there are opportunities in small mid caps now, post the correction, where we see attractive risk reward coming in. But at a broader space, we would still advocate large caps over small caps.
So I'll put this data out, Gautam, about the Nifty 15 numbers. And I have the Bloomberg consensus for FY26. It's 1200 rupees. I divide 1200 with the current level of 22,000. That gives me a P multiple which is closer to 20. Now, closer to 20 means that you are in and around historical averages. So anything in and around 20,000, 21,000 for the Nifty, does that make it look attractive?
In an absolute theoretical valuation framework, no. But again, this is after a correction we have seen, the positioning has become lighter, and these levels are after seeing negative growth surprise and absolute terms lower growth. Now the hope and expectation is we will see correction in policy, which will get the growth recovery back. And if the growth recovery happens, then the markets seem reasonably valued. That's the way I'll put it.
Will markets wait for Q1 before they firm up? Will institutional investors wait not for, when I say Q1, Q4 numbers before they make up their mind?
So at a broad directional level, not Q1 necessarily, if you're talking about Q1 FY26, but for Q1 of this calendar year, possibly. Again, the queries we get from FIIs or local clients around what's happening on the ground are at an elevated level. So clearly, they don't want to wait for the print to happen. They would look for signals from on the ground and also policy signals. We have a new RBI governor, we have the budget. Are there policy signals which suggest course correction and therefore try to preempt that? So in a short way answer, they won't wait for the print, clearly. And there are tools which they will employ to be ahead of the curve.
Interesting. Gautam, I just want to go back to the point that you were earlier making, that there are some small and mid caps out there wherein the risk reward is favorable. Any sectoral highlight that you can give us? What's looking interesting?
So look, again, I won't bite on the sectoral level, but in general, leisure, real estate, healthcare, by healthcare, I mean hospitals, etc. Those are the segments where we see attractive risk-reward opportunity. But again, I'll caveat that by saying it's much more about individual stocks rather than sectorals.
Gautam, does it seem like that's how the market is going to be all through 2025? We were chatting earlier this morning that a large chunk will underperform, a large chunk would stay status quo, and there is only a minuscule bit which will outperform. Do you think 2025 is going to be more about individual stocks rather than across the board, across the sector theme kind of market?
Absolutely. Look, in general, it's always fashionable to say India is a bottom-up stock picking market. But beyond that, 2025 will be clearly that theme playing out. Or I use the word theme, but it's going to be a lot more about individual stocks. And we see that across sectors when we see analysts trying to predict or make their stock ideas. Like there's no sector I can think of where there is a universal consensus bullish or bearish view from our analyst here. It's much more about stocks within the sectors.
Gautam, we've underperformed global markets, which is that S&P at an all-time high. We are nowhere close to an all-time high. There would be a time somewhere where US markets will start topping out. If US markets stop, whenever they do you think Indian outperformance will come back, or we are unlikely to align with we are unlikely to align with them?
So look, my simplistic way of thinking is the outperformance is more likely when the global economy and markets are doing well rather than when global markets and economies are not doing well. Because when global economy, the US economy or markets don't do well, it becomes far more tricky to predict India's outperformance or underperformance, or to make a big call on India's outperformance. Now, you could argue that India's economy should be much more resilient in theory, but the growth does get impacted or affected. And even a smaller cut in growth outlook in India, it does affect earnings and it does affect market multiples, as we have seen the last couple of quarters. So, so the ideal scenario is when the world economy is doing well, US economy is doing well, and markets are doing well, and India gets back into its growth trajectory, which we saw in the last few years. And that's the best scenario for India to outperform.
Okay. So Gautam, if you have to, let's say, build a portfolio which could be perhaps low on return but high on safety, what would that portfolio contain?
It would be a mix of large private sector financials, selective, very, very selective pharmaceutical stakes, because generally pharmaceutical we are cautious, but there are opportunities there. IT we will stick to, especially the large high quality ones, because there's a reasonable level of safety and they are well placed in most scenarios. The consumers are much more tricky because there could be downside to earnings, etc., as we saw in a couple of margin misses in this quarter. So if you're looking at a 1 year perspective, then yes, but in the short term, I would still be a bit cautious around the consumer names. And then goes back into some other sectors like healthcare, leisure, exchanges. Those sectors should do well.
So good having you on the show today. Thank you so much for your time.
If you like this video, then like, share and subscribe to ET Now.